There's a massive disconnect happening right now in the markets, and if you don't see it, you're about to get blindsided. Welcome back to TechMeHome, MarketPhase Daily News. Today is Wednesday, May 13th, 2026, and Wall Street just admitted something they've been hiding for weeks. Rate cuts aren't coming, at least not anytime soon. Let's break this down. The entire stock market rally we've been watching, especially in tech, has been built on a single assumption. The Federal Reserve would start cutting interest rates by mid-year. Lower rates mean cheaper money. Cheaper money means companies can borrow for free. Free money equals higher stock prices. It's magic, or at least that's the illusion they've been selling us. But Bank of America just came out and said, not so fast. The data doesn't support it. Inflation is stickier than they thought. The Fed's hawkish. And rate cuts are further away than investors are pricing in. Look, if you're holding growth stocks or tech right now, you need to protect yourself. That's why platforms like TD Ameritrade and Fidelity have built-in tools to help you hedge your positions with option strategies. You can actually profit when the market turns. It takes 5 minutes to learn. Setting yourself up defensively isn't cynical, it's smart. Click the link in the description to see how. Here's the thing about BofA's warning. It's not some random opinion. This is the second largest bank in America. They have access to proprietary data, Fed messaging, and economic forecasts that the average retail investor doesn't. When they issue a cautionary stance, it signals Wall Street skepticism, and that contradicts market expectations. So what does this actually mean? Think of it like a casino, right? You walk in, and the house tells you, bets are paying out at 3-1 because we think the dice are rigged in your favor. Everyone starts betting huge. Then the casino manager walks out and says, actually the dice aren't rigged. Bets are back to 1-1. Suddenly, all those big bets look stupid. That's what's happening to tech stocks right now. They've been priced for rate cuts that might not happen until 2027. If the Fed stays higher for longer, valuations get compressed, growth stocks get crushed, and the rally evaporates. But there's a second layer to today's story that could actually save the market from complete collapse. Nvidia's CEO is joining Trump's delegation to a historic Trump-Xi summit. Why does that matter? Because semiconductors are the crown jewel of American tech. And right now, they're rallied on hopes that trade negotiations could actually ease tensions with China. Nvidia, Micron, Intel, all benefiting from optimism that supply chains won't get completely decimated by new tariffs. The summit looms large. If Trump and Xi actually find common ground on trade, it could validate the current rally. But if negotiations go sideways, semiconductor stocks crater, and with them, the entire tech sector. Meanwhile, Alibaba just reported earnings that reveal a darker truth about AI spending. The Chinese tech giant missed revenue expectations and is being crushed by margin compression. Why? They're spending aggressively on AI infrastructure. Everyone is. So here's the paradox. Companies are spending billions on AI to stay competitive, but those investments are destroying profitability today. And if rates stay elevated, they can't borrow cheap money to fund those losses. Alibaba's margin squeeze signals that tech profitability remains challenged. Big cap international tech exposure is getting toxic. Coinbase is one bright spot. It missed earnings but held key technical levels. That suggests underlying strength in crypto and digital assets, but elevated volatility remains. Macro uncertainty is the wild card, which brings us to tonight's critical data point, producer price inflation readings. PPI is essentially wholesale inflation. It hits before consumer prices do. Fresh PPI data could either validate the Fed's hawkish stance or give them an off-ramp to cut rates sooner. The timing is crucial. We've got geopolitical tension spiking commodity prices, we've got trade negotiations happening, we've got earnings season in full swing, and we've got a Fed that's sitting back watching the data, deciding whether to keep rates higher or finally give the market what it wants. So what do? First, accept that the easy money rally is probably over. Second, watch the PPI data like a hawk. If inflation stays sticky, rates stay elevated. Growth stocks suffer. If inflation rolls over, the Fed gets cover to cut. Tech rallies again. Third, pay attention to the Trump-Xi summit. Trade policy could reshape which sectors actually benefit from the current environment. Semiconductors could soar or implode based on negotiations. And fourth, understand that this mixed market performance, tech rallying while the Dow slips, isn't healthy. It's fragile. It's a market where winners and losers are diverging wildly. That's typically a warning sign. The illusion of easy money is cracking. The Fed can't print away real inflation. Rate cuts that were supposedly guaranteed are now in doubt, and the earnings growth needed to justify current valuations isn't there. Not at Alibaba, maybe not at Nvidia if trade goes sideways. Stay sharp, watch the data, and remember, the market giveth and the market taketh away. Today it's giveth on chips and crypto. Tomorrow could be a completely different story. None of this is financial advice, purely for entertainment. Always do your own research before making any investment decisions. Thanks for watching TechMeHome. We're back tomorrow with MarketPhase Daily News.